In this video, you'll learn how payroll accountants determine federal tax withholdings using the wage bracket method. Mandatory deductions include federal income tax for all employees. This is an employee-only tax, which means that the employer does not contribute a matching amount like employers do for FICA tax. The starting point for calculating the federal withholdings is the Form W-4, which is completed by the employee on paper or online. The employer acts as the collector and depositor for these funds. When the employee files the income tax return, the amount withheld from his or her pay during the year reduces the amount he or she may have to pay with the tax return. It is important to note that federal income tax is reduced by pre-tax deductions, such as employees' payments for health insurance, 401k, and cafeteria plans. Many companies use software programs or an external service to calculate the federal income tax withholdings. However, if a company uses a manual system, there are two commonly used methods for calculating federal income tax. One, the wage bracket, and two, the percentage method. So let's look at some examples of how pre-tax deductions reduce period wages to arrive at taxable income. The first example is for Heather, who is an employee with a period gross wage of $2,815. She elects to have 5% of her gross pay withheld for a 401k contribution and has no other pre-tax deductions. What will be her taxable income for federal income taxes? We write down the gross wage of $2,815 and then calculate the 401k deduction, which is $2,815 times 5% or $140.75. We subtract the pre-tax deduction from the gross pay, which results in $2,674.25. What about the next example? Amanda Brady has gross wages of $950. She subscribed to the company's cafeteria plan, and she has agreed to a 10% investment of her gross wages in a qualified 401k plan. Her portion of the health insurance is $56.90 per pay period. So first we'll write down Amanda's gross wages of $950 and calculate her contribution to the 401k by multiplying $950 by 10%, which is $95. We write this amount down as a pre-tax deduction and then enter the pre-tax deduction for the health insurance of $56.90, arriving at taxable income of $798.10. Let's talk about the wage bracket method for calculating federal income taxes. Using the wage bracket method, the payroll clerk identifies the individual's marital status, number of exemptions, and taxable income level, and then follows the chart in Publication 15T for the amount to be withheld. If manually calculating the wage bracket method, it is important to apply the appropriate number of withholding variables before calculating the tax amount. The wage bracket method is useful for manual payroll preparation because the process of federal tax withholding is an estimate for the year-end amount of taxes due. The payroll clerk may use Publication 15T, but will be using the tax tables in Appendix C of the textbook. So here we have an example of Steve Bishop, who is an employee at Vosgian Farms. He is single with no dependents and earns $48,000 annually and is paid biweekly. We'll use the wage bracket tables in Appendix C to determine Steve's federal income tax in three different situations. First, we'll calculate the federal income tax withholding if Steve has no pre-tax deductions by taking his annual pay and dividing it by 26. Get the gross wages per period, which is $1,846.15. We then go to Appendix C of your textbook to find the biweekly payroll period for the wage bracket method. When looking at the tax tables, it's important to ensure that you have the right table. We're looking for the table that shows 2022 wage bracket method tables for manual payroll systems for Form W-4 from 2020 or later. We'll also need to find the table that shows biweekly payroll. That is page 457. Then we need to locate the correct marital status column and the correct wage row that shows the wage we're looking for. So for Steve, we need to find the row that includes his wage of $1,846.15, which is about in the middle of the page. It's the row that starts with 1,830 and ends with wages less than 1,850. Then we move to the right until we find the standard withholding column for single taxpayers, and we find $153. But how do the withholdings change when Steve has pre-tax deductions for health insurance of $75 and supplemental health insurance of $55? Well, Steve's taxable income decreases to $1,716.15 because the insurance contributions are pre-tax deductions. So we now look up $1,716.15 in the tax table and find $139 in income tax withholdings. Our last example is like the second example, but we have an additional pre-tax deduction for 401k deductions of $100, which lowers the taxable income to $1,616.15. Going back to the table, we find the correct row for the taxable income of $1,616.15, which is $127. Here's another example that illustrates what we have to do when employees have dependents. Wolf Industries pays its employees on a semi-monthly basis. Using the wage bracket tables in Appendix C, compute the federal income taxes for the following employees of Wolf Industries. No information was included in Step 4 of any W-2 except McCollum checked the box in Step C. Assume that no pre-tax deductions exist for any employee, and Box 2 is not checked for all other employees. So let's look at the first employee, T. Cantor. This employee has taxable income of $1,205, and the filing status is married filing jointly, and there are no dependents. There are no pre-tax deductions, and therefore the gross income is also the taxable income, which we will use to look up the tax in the semi-monthly tax table, which is highlighted with a green rectangle and shows $13. Now let's look at the next employee, McCollum. For this employee, you have to remember that box 2C is checked. We'll pull up the tax table and we see that the tax is $139, which is highlighted with a blue rectangle. However, the employee's federal taxes is reduced for the two dependents under 17. Each of these dependents accounts for a reduction of $2,000 per year. That means we multiply 2,000 by two dependents and then divide the $4,000 by 24 because it's a semi-monthly payroll, which results in a reduction of taxes of $166.67, which reduces the total tax down to zero. Hammond and Elliott also have zero final taxes because they have dependent deductions. Please give it a try and go through the steps of looking up the taxes for Hammond and Elliott. Here's another example that illustrates what we have to do when the employees have dependents as well as additional withholdings from a spouse's income. It is very similar to your homework. Moravanti's Italian imports his 4 employees and pays biweekly. Assume that box 2 is not checked for L. Tarabi and R. Benanati and is checked for G. Fisher and J. Tillman. So the first 2 employees, Tarabi and Benanati, are very similar to the prior examples on the prior slides. And that's why I won't go over the detailed calculations, but please make sure that you're comfortable with the calculations. Now let's look at Fisher. Fisher is married filing jointly and has 3 dependents under 17. The annual salary is $24,000 and the spouse's salary is $40,000. We'll first calculate the biweekly wages of $923.08 and then look up the federal income taxes in the biweekly tax table. It's $43. The 3 dependents are worth $2,000 each for a total of $6,000, which we divide by 26 to get the biweekly reduction of $230.77. We subtract the dependent deduction from the tax we previously looked up of $43 and come up with a tax of 0 because the dependent deduction do not result in negative taxes. So very important. But I'm not done yet though. We need to look up the additional taxes because the spouse has income and we do that on Form W4 on page 4. The intersection between Fisher's salary of $24,000 and the spouse's salary of $40,000 is $3,160, which we divide by 26 and arrive at $121.54. We add this amount to the final tax of $0 and arrive at a total income tax of $121.54. Tillman's federal income tax calculation is actually very similar. Tillman is married filing jointly, has 2 dependents under 17. The annual salary is $41,300 and the spouse's salary is $24,780. We'll first calculate the biweekly wages of $1,588.46 and then look up the federal income tax in the biweekly tax table, which is $122. The 2 dependents are worth $2,000 each for a total of $4,000, which we divide by 26 to get the biweekly reduction of $153.85. We subtract the dependent reduction from the tax we previously looked up of $122, and it reduces the taxes down to $0. We're not done yet, though. We need to look up the additional taxes because the spouse has income, and we do that on Form W4 on page 4. The intersection between Tillman's salary of $41,300 and the spouse's salary of $24,780 is $3,160, which we divide by 26 and arrive at $121.54. We add this amount to the final income tax of 0 and arrive at a total income tax of $121.54.